The Fed seeing rates near zero through 2022. At that news conference yesterday, Chairman Jay Powell used phrases like, quote, considerable risks, and said that we will, quote, do whatever we can for as long as it takes to support the economy. And the professor joins us this morning, Steve Liesman, with more on all of it and how to read it, Steve, how to read it.
Yeah, I think, Andrew, the way to read it is the Fed throwing a little bit of cold water on the market's exuberance over the outlook. Look, he gave them everything they could have possibly wanted when it comes to the outlook for rates, but it's the outlook for the economy that was really the cold water on the market yesterday. Take a look. The Fed is saying it's projecting rates being low for years, all the way out through 2022. It's going to continue at least $120 billion of monthly QE. But the reasons for that, why is it doing it? It's doing it because it's going to be a very long road back. Becky was just talking about these numbers. Let me show you a graph with them. And first of all, the yellow line is the GDP outlook. It was going to be 2%, 3%, whatever it was going to be. Now it's going to be down 6.5% this year, up 5%. In other words, above trend the next 2 years. But you have to do the math on that. You don't get back where you were until the middle of 22 in terms of getting back lost GDP. Unemployment rate remains elevated throughout the 3-year projection phase there. So we don't get back to 3.5 at any kind of hurry. It takes a while to get there. Now, I asked Powell yesterday about the good news, about the idea that the job report was better than expected, and asked him how he would process that. And here's what he said.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
And the reason for that is you have to take the ice cream you're getting with the idea that, hey, there's going to be something bad down the road here, which is why you're getting all that ice cream. And that is really because he does not see the labor market improving that quickly.
My assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job. And in fact, there may not be a job in that industry for them for some time.
Andrew, Powell has always emphasized the uncertainty of outcomes. I feel like the change here among Powell and maybe other members of the Fed is they're now more certain of difficult outcomes than they were in the past. The idea that no matter what happens here, it's going to be a long road to recovery.
Steve, the question I'd ask you is, how much of a distinction you think there is between Jay Powell's view of the markets, between the administration's view of the markets and the market's view of the markets, at least up until yesterday?
I mean, those are three questions. I think that Mnuchin, even yesterday, in arguing for additional stimulus, suggested that maybe it's not going to be such a quick rebound. Other members of the administration have been much more upbeat. And the market, I think, look, it's hard to say exactly what the market was thinking. I think the market thought it could get all of the good stuff, the low rates and the QE, without any of the bad stuff and a quick recovery. And I think Powell yesterday put those two things together. Yeah, you're getting low rates, but you're getting low rates because the economy is just not going to get back to where it was as quickly as thought. And I don't know if yesterday was the sort of cold water that woke up the markets, if it saw the numbers the Fed put on it in the projections or heard what Powell said. But there's a reason why rates are going to remain low. It's not all good that you're going to keep those rates
Steve,
at that level. It's because it's going to be challenged.